Hi, my name's Maura Riley Kennedy, and I'm a managing director on Neuberger Berman's private markets team. I've been a member of the team since 2008. Today, Helen and I want to introduce the private equity asset class with the goal of highlighting how the unique characteristics of private equity can translate into unique opportunities for your portfolio. Our goal over the next 50 minutes or so is to help increase your comfort level with this asset class and share some ways it can be incorporated into a portfolio. With that said, let's get started. Our presentation today will do a few things. We'll define private equity, we'll discuss some of the advantages of including private equity in a portfolio, and highlight potential challenges associated with the asset class. Finally, we'll discuss the mechanics of the asset class and its underlying strategies. Let's start with the basics. The first question I want to address is, what is private equity? Simply put, private equity is an investment into a company that you can't typically access in the public markets because it's privately held. The investment universe for private equity is vast. Private companies range from small, family-owned businesses like a mom-and-pop shop down the street to larger companies like PricewaterhouseCoopers or Neuberger Berman. Private companies are found across industries and business sectors. Examples include an industrial company, a consumer-focused company, or a company with up-and-coming technology. And finally, there are companies of all sizes, from startups and venture capital-backed companies to small, mid-cap companies to even large-cap companies that are well-established, privately owned businesses. Private equity is a long-term investment. When you commit $1 to a private equity investment, it's important to know that you're in this for the long haul. These investments are typically held for multiple years, and your capital can be locked during those years until you receive any cash back or you've reached the end of a fund's term, which can be 8 to 12 years depending on the strategy. There are certain vehicles, like evergreen private equity structures, that do provide some liquidity, but in comparison to public markets, private equity is generally considered illiquid. Another important question is, how do you invest in private equity? There are generally two ways. The first is a direct investment. This is when your capital goes directly into a private company. This can take the form of equity or debt. The second is through a fund investment. This is when your capital goes into a fund that is usually managed by what's called a general partner or the manager of the fund. The general partner then seeks to invest in direct investments on behalf of the fund's investors. The general partner makes the investment decisions, and investors are passive, relying on the general partner to identify, invest in, and monitor the best opportunities for them. In other words, you can access private equity by buying directly into a company, like buying a share of a public company, or through a fund, like investing into a mutual fund for the public markets. The next question is, who invests in private equity? In terms of the client base, historically, private equity was reserved for institutional investors or ultra-high net worth individuals. This was largely driven by high minimums and high eligibility requirements. As the asset class has evolved, new structures have been introduced and regulation has changed. Private markets have become more accessible, and now individual investors are getting more involved. Today, private equity can be found in the portfolios of institutional investors and individual investors around the world. Which leads us to the next slide, which demonstrates the growing adoption of private equity into portfolios. This is no longer an asset class just for institutions, but is one for individuals as well. The number of institutions and individuals investing in private equity continues to grow and is a large driver behind the growth of the entire asset class. And what's the genesis behind this? There's several drivers. First is growing understanding of the asset class and the value it brings to an overall portfolio. New products, new vehicles, more liquid vehicles, and technology that's just made it easier to invest. Perhaps just as important is that allocations to private equity as a portion of a total portfolio have also grown. private equity has evolved from being a small, specialized allocation within a portfolio to a core holding for almost all types of investors. Before we do a deeper dive into why private equity has become more prevalent in investors' portfolios, I'd like to take some time to talk through the differences between public equity and private equity. Public equity, which many are very familiar with, has daily liquidity. You can go online and click a button and get invested immediately. You can then click another button to sell that position immediately. You're also getting daily pricing. You know every day what the price of your stock is, and if it has gone up or down from when you first purchased it. There's also a lot of regulation around public stocks, so you get the same information that everyone else gets. It's equal access to equal amounts of information. You can also easily analyze your performance based on a benchmark. If you're looking at a large cap stock, you can look at the Russell 1000. If it's a small cap stock, you can look at the Russell 2000, and so on. It's really easy to track the performance versus the overall index. You're also a passive investor. You're relying on the company's management team to drive value and the earnings calls to give you an opportunity to understand what's going on. You're kind of along for the ride. You don't have the ability to change the direction of the company or how things are run. Now let's turn to private equity, which is a bit different. The first key difference is that there is very limited liquidity. Your capital gets invested over several years. It's a long-term investment. There is no easy exit. If you wanted to sell your position, your only option is on the secondary market and identifying a buyer. Another difference is frequency in reporting. Updates on how your investment is doing are provided quarterly and often provided with a quarter lag. You rely on the general partner and their reporting to give you the insight into how an investment is performing, what it is worth today, and the future value potential. As such, transparency can be a bit limited in private equity. Performance is also not straightforward. There are a few private equity benchmarks that are often used, but while some have selection bias, others may have insufficient number of data points. It's not as clear-cut as it is with public equities. However, probably one of the most important differences between public and private markets is that for private equity, the investment is very active. When private equity managers are buying into a business, they have the ability to affect change, hold management accountable, make operational improvements to these businesses, and to really drive change in that business. We'll elaborate on the importance of this difference later in the presentation. So why are investors so interested in private equity? What are some of the advantages? And also, what are some of the challenges? We believe there are 3 key reasons to invest in private markets. Reason number 1, diversification. The investment universe for private equity is large and is generally not accessible via public markets, providing a good complementary allocation to a public allocation. Reason number 2, private equity has the ability to affect change in the underlying portfolio companies to drive value and therefore returns to investors. And finally, reason number 3, performance. Private equity represents an attractive investment opportunity across market cycles and has generally outperformed public markets. Now let's dive into each of these a bit more. This slide shows how private equity can add diversification to a portfolio. The private market universe gives an investor access to more companies than the public markets can, and with no overlap. Looking back to 2000, we see that private equity-owned businesses were a smaller part of the investable universe. Fast forward to 2023, we see that the number of private equity-backed companies is about double the number of publicly listed companies in the United States. What this tells us is that to really get exposure to the US economy, one needs to have exposure to private equity because public markets only give you exposure to a portion of the overall investable company universe. Another way private equity can add diversification is through exposure to different sized companies. As you can see from this chart, the average private equity company is smaller than the median size of companies in the Russell 2000 small cap index. In other words, while public markets provide exposure to large cap companies, exposure to smaller companies is achievable through private equity. Finally, for a number of reasons, companies are staying private longer, and in some cases, deciding to stay private and never go public. If you look at the top left chart here, pre-2001, companies were, on average, going public at 8 years old. Often, the ultimate goal for a management team was to go public. Looking to post-2008, the average age to go public increased by an average of 3 years. Companies are staying private longer. Looking to the top right chart here, you can see valuations are much higher when companies ultimately do decide to go public. Pre-2001, average market cap was about $300 million. Post-2008, the average company market cap at IPO was over $2 billion. Look at Amazon. Founded in 1997, the company went public after only 3 years. It went public at a $600 million valuation. If you invested in the IPO and you timed that share purchase correctly, you've made almost 2,500 times your capital. That's a great investment. Now, let's fast forward to the more recent environment. Look at Uber, which was founded in 2010. Uber went public in 2019, so 9 years after they were founded, and at an $80 billion valuation. If you bought shares when Uber IPO'd, you've made a solid return, but you're missing out on the huge growth opportunity that happened for the private investors. If an investor is only looking at the public markets, they may be missing out on this massive growth opportunity in private companies. To sum up the first advantage of private equity, you're getting diversified exposure through a wider universe of companies, representing a different market cap, and also potentially getting access to successful companies earlier in their life cycle. Private equity advantage number 2, the ability to create value in investments. This is where private equity managers really shine. This advantage can be summed up in 3 ways: on the buy, during the hold, and on the sale. On the buy, in public markets, everyone has equal access in terms of opportunity and information. To have any advantage would be considered MNPI. In private equity, the market is just less efficient. If you have an information advantage, you can use it to make better decisions about what to buy and how much to pay for it. Then on the hold, public investors are passive and have a limited ability to have an effect on a company they buy. Private equity investors, on the other hand, have a true value-added investment strategy. Private equity managers have control over the companies they invest in, which allows them to make operational and structural improvements in the companies, to increase earnings and make those businesses fundamentally better and therefore worth more. Last is the sale. Private equity can be patient capital. Thanks to the long-term nature of private equity structures, private equity can time not only when they buy a company, but also when they sell, seeking to maximize returns. They can not only choose timing, but also how to sell, an IPO or a strategic sale, for example. This comes in handy, particularly in a downturn. Many mutual funds, for example, may be forced to sell good underlying assets at low prices in order to meet redemption. That doesn't happen in private equity. This advantage, the ability to create value during an investment, is what makes private equity very interesting to investors. And that ability to affect change in a portfolio company and therefore create value shows up here in performance. Private equity over a long time horizon has outperformed public markets. Looking at the 5, 10, 15, 20-year time horizon, we see that the average global private equity index has outperformed the MSCI World by several hundred basis points, and that's the average. Looking at the first quartile, top managers are on average outperforming by over 1,000 basis points over the same time horizons. It is essential that you pick the right manager in private equity. While performance results can never be guaranteed, the potential return enhancement that private equity can provide in a portfolio is another really attractive aspect to private equity investing. When thinking about performance, one also needs to think about risk. This chart highlights 3 different portfolios, each with a different allocation to private equity. It's an important chart considering that investors are weighing the potential benefits of taking assets out of a stock portfolio to deploy into private equity. The pie at the bottom right has a 0% allocation to private equity. Then private equity is included in a portfolio as shown in the middle and left-hand pie charts. Think back to that diversification benefit of private equity and the chart with 12,000 private equity-owned companies in the US that we showed earlier. The inclusion of private equity enhances the overall equity diversification of a portfolio. That's going to decrease the standard deviation while enhancing the overall total return profile of a portfolio. Historically, people have viewed private equity as a risky investment or an alternative investment, but it's really all about diversification. It's about tapping into a broader investable universe, which can help you increase the diversification of a portfolio or which seeks to mitigate risk. Okay, so we've talked about the good, and what about the bad? Let's talk about some of the considerations associated with private equity. First is illiquidity. Private equity is typically an illiquid asset class. When you're investing in these businesses, or when you invest in a private equity fund, a manager is looking for companies to own for a number of years, during which they'll seek to create value. Private equity funds tend to have 10+ year fund terms. You're locked in for years. Investors get back distributions or cash flows from selling companies over time, but investing in a private equity fund means that you are in this investment for a long period of time. Second, there's an element of imprecision in valuation. As I mentioned before, valuations are typically done quarterly and often lagging by a quarter. They're also estimates of what the general partner believes the company is worth at that time. Until that company is actually sold or realized, all that value is unrealized. The value is a hypothetical or theoretical value that the manager believes is fair value. But until they sell that company, you don't know exactly what the value of that business is. And as I mentioned in the first consideration, it can be a long time before that investment is realized. Finally, the long-term nature of a private equity investment can be hard for some investors to manage. Capital isn't invested immediately. It's called over time, making cash management difficult for some investors. Distributions are unpredictable, further complicating the ability to manage a portfolio. Some investors struggle with the uncertainty of timing associated with managing a private equity portfolio. There are new and innovative structures like evergreen private equity funds that have been introduced that seek to solve for some of the above-mentioned pain points, but certain considerations still persist. Overall, we believe in the power of private equity and believe that the advantages of including private equity in a portfolio outweigh the considerations. And for investors who can afford illiquidity in a portion of their portfolio, private equity should be included. And with that, I'll turn it over to my colleague Helen to cover the mechanics of private equity and how to access it.
Thank you, Maura. My name is Helen Zhang, and I'm a vice president on the private markets investment team, focusing on fund and direct investments. I'm going to spend the remaining time to talk about the mechanics of how PE works and the different ways that one can invest into PE. I'll first go over how a fund works structurally. The fund is generally structured as a limited partnership. The general partner, or commonly referred to as the GP, manages the limited partnership. This essentially means they make all the investment decisions for the fund, as well as control the fund's day-to-day operations. This team seeks out investments, makes them, and then monitors them. The investors in a private equity fund are known as the limited partners, or LPs. They invest in a fund by purchasing interests in the partnership. They rely on the GP to make the investment decisions for the fund and are entitled to the returns the fund makes. As you can see from this chart, the LPs invest into the fund or partnership, which is managed by the GP. The partnership then invests into private equity companies. The limited partner usually compensates the general partner through a management fee and a performance fee, which we'll discuss later in the presentation. Often, the manager or GP will also invest into the partnership to ensure their interests are aligned with those of the investors. So how does one access private equity? There are two key ways: directly or through a fund. In a direct investment, the investor is investing directly into a private company. They can invest directly by either providing equity, for example, a co-investment, or by providing debt, or in other words, private debt. One can also provide a complete solution that involves both equity as well as debt. The other way is through a fund, and there are three key types of fund investments. The first is called a primary investment. Here, you invest into a fund that then invests in private equity companies. Primary funds can be diversified, investing across different strategies globally, or specialized. For example, they can just focus on an industry like technology, or in an area like venture capital, or even just on a geographical area like Europe. The second type of fund investment is called a secondary. As you may recall earlier, private equity funds are illiquid, often requiring you to commit your capital for 8 to 12 years. For investors that need to exit before the end of the fund's life, they can sell their interest on the secondary market. If you purchase an interest into an existing PE fund from an existing investor, this is called a secondary. Often, capital in the fund has already been deployed, so you have some insights into what the portfolio looks like. Because the seller needs to get out of the position, you can sometimes purchase the interest at a discount. To distinguish between primary and secondary, you can think of a primary as an investment into a new fund, whereas in a secondary, you're investing into a fund that has already begun to make investments, and in some cases may already be seeing exits and distributions. Finally, the third type of fund investment is a fund-to-fund. Here, you're investing into a fund that then invests into other funds, and then those underlying funds make investments into private equity companies. These commitments are typically the most diverse, with investments across managers and portfolio companies. The next few slides will depict what we just reviewed. This demonstrates how a co-investment, or a common type of direct investment, works. Let's say a company costs $100 million. A private equity firm wants to acquire it, but only has $60 million of capital available to buy the company. To get the remaining $40 million of capital, they will go out and look for co-investors, or others to co-invest alongside them. They can do this through what's called a syndication, where they offer it to a broad group of potential investors, or on a more exclusive basis, where they approach a few select investors. The firm leading the deal, the one putting up $60 million, is known as the financial or lead sponsor. The others making up the $40 million of remaining capital are known as co-investors. You can see from this illustration that the sponsor and all the co-investors commit directly into the company. One thing to note here, people often talk about access when it comes to co-investing. Having relationships in the industry is very important, particularly when you want to make direct investments, because when lead sponsors look for co-investors, they get to choose who to call and who to give the opportunity to. So often, even if investors want to make direct investments into PE, they may not be able to if they do not have the relationships with private equity managers. This slide illustrates a primary investment. Here, an investor invests into a fund and then goes out and makes direct investment. A key thing to note here, as the end investor, you are now relying on that manager to have either the relationships to get access to direct deals or the ability to execute deals themselves as the lead sponsor. If the fund, instead of investing in direct investments, invests in other funds, then that's when you have a fund of fund. The additional layer provides the investor with more diversification, but may also come with more fees because you may be paying the manager at the fund level and then also at the underlying level. Lastly, secondaries. Secondaries is the way for the illiquid asset class of private equity to have liquidity. Secondary buyers find seasoned positions, whether it be in private equity funds or private equity assets, to provide liquidity to their investors. Think about a pension or endowment who has a new CIO come in and they may say, "We want to rebalance our portfolio, but we're in illiquid funds." They will turn to the secondary market or another private equity manager to come in and acquire their position. There's no formal way to sell your positions other than finding a secondary buyer. What's nice about a secondary is that often the fund has already started to invest. Therefore, the secondary investor can see what the portfolio looks like and have more visibility into the underlying holdings of the fund and more insight into the direction the portfolio may be going. When making an investment into private equity, one common term used is the J curve. To understand this, I will walk through how private equity timeline works. In a traditional private equity fund, there are essentially three parts in the life cycle. First is the fundraising period. This is when the manager is raising capital or seeing investors to persuade them to invest into their fund. Investors will make what's called a commitment, or in other words, an investment into the fund. The manager will continue to raise capital until they reach a fundraising target, at which point they will hold a final close and no longer accept new investors into the fund. Then comes the investment period, which is the period in which the manager commits to investing your commitment amount. A key characteristic of private equity is the capital call. If you commit $1 million into a private equity fund, that $1 million isn't taken from you on day one. Instead, the private equity manager will draw upon that $1 million over the investment period as they make investments. If you are the only investor in the fund, the first investment is $250,000. The manager will then call capital from you totaling $250,000 of your $1 million investment. They will then continue to draw on your $1 million until you're fully committed or when they have invested your total commitment amount. You, as an investor, need to know that at any point during that investment period, or really throughout the term's life, you must be ready to have that capital available. The investment period will typically last 3 to 5 years, and then you'll enter the third stage, the divestment or harvesting stage. That's when the underlying companies start to get mature. When the manager starts selling these businesses or realizing these businesses, which can be achieved through an IPO, or when they sell a company to a strategic buyer, among other ways. That's when distributions start occurring, or when the manager begins sending capital back to you. Throughout this harvesting investment period, think about years 5, 6, 7, and so on, you're going to start to see cash flows back to you, real profits in your investment. We mentioned earlier that PE investors create value in the underlying company. This takes time. Changing management, executing strategic acquisitions, improving operations, whatever the value creation plan is not something that can be turned overnight. This is why PE is a long-term investment, because it takes time to see the fruits of the value creation plan. An investor often experiences a J-curve. In the early years of investment, your cash flows are negative, which means your return is negative because more money is going into making the investments and you have yet to make any money back. As distributions are made and investments become realized, your cash flows then begin to become positive, usually around years 3 to 7, hence the J curve. You're negative in the early years, but eventually start seeing returns and are in the green and seeing positive performance. Now that we know how PE works, how do you measure performance? How do you know if your investment is performing? Private equity funds typically show 3 measures for performance. The first is IRR, or the internal rate of return. Internal rate of return considers the timing of cash flows. The shorter the period between when you invest and when you start earning money back, the higher your IRR. The pro of IRR is that it considers the time value of money, but the con is also that it can fluctuate. For example, if you have one early exit, but then a lull, IRR can be artificially inflated initially given the early cashback from the early exit. Another measure of return is total value to paid in, TVPI, or also commonly referred to as multiple on invested capital, or MOIC. This is the total value of your portfolio today over the amount that you invested. If you see a 2x multiple or a 2x TVPI, that means that now we're valuing the current portfolio at 2 times what you invested in the fund. It's important to think of MOIC or TVPI at the same time as you're thinking about the internal rate of return. You should view those two together because it's not showing you the annualized rate of return, but what the total value of how much you've invested in the fund is worth. However, total value may include returns that you have yet to receive. The portfolio is worth this amount today, but that doesn't mean the return has been realized and that the cash is in your pocket. That's when the third measure of performance, distributions to paid-in capital, or for short, DPI, comes in. DPI is important. It shows you how much money you've received back and put back into your pocket. At this point in time, if you receive 20% of your invested capital back, it will be a 0.2x DPI. Once you reach 1x DPI, that means that you've received all of your capital back that you've invested in back to you. Anything above a 1 are profits that you've received on top of your initial investment. This is how private equity funds are typically measured, but how do you know if this performance is good or not? To evaluate performance, investors have numerous options for benchmarking their private market portfolios, with each method providing their own sets of merits and considerations. The first is the most straightforward, and that's just to look at the performance on an absolute basis. If you target a 15% return for your PE portfolio and the current return is 15%, then you know you're on track. This is easy to implement, track, and understand. The other way is to measure performance on a relative basis, in other words, comparing it to a benchmark. Unlike the public markets, you can't go online and see the Russell 1000 or the Russell 2000 and get a true understanding of that versus your private equity allocation. Investors will need to generally rely on a benchmark put together by a third party, such as Preqin, PitchBook, Cambridge, or Burgess. These providers aggregate performance of various PE funds. Each have their own pros and cons, the latter which is particularly important to take into consideration and can include things such as selection bias, reporting delays, etc. Investors will then need to consider what year these investments were made, what sectors they were made in, what type of transactions their investment represents to properly compare performance on a relative basis. Because PE is a long-term investment, measuring performance in the first year of a PE performance's life is generally not a good indication of where it will end up. As mentioned before, capital is still being deployed and realizations haven't been reached yet, so IRRs will be very low or even not meaningful. Early investments are typically held at cost for MOIC or TVPI, which means it is held at 1 times. because the PE firm hasn't had time yet to implement changes and see those results. Thus, when looking at performance, you need to take the early years with a grain of salt, as it will take time for the PE investment to settle before you have a good indication of performance. And finally, you can compare PE to public markets. Because of the way PE is structured, where it calls capital and distributes capital over time, when comparing PE to public, investors need to take this into consideration. As such, many employ what is called the public market equivalent, which in very simple terms, invests into the public markets when the PE investment calls capital and then sells when the PE distributes. This offers a more apples-to-apples comparison between PE and public markets. The con of this method is that it can be very complicated to calculate. Investors who use the PME method to measure private equity performance may also impose a premium. So the PE investment needs to outperform the public markets by, say, 3% to be considered outperforming. This premium considers factors such as illiquidity that one takes on when investing in PE. Investors may use one or more of these methods when measuring the performance of their PE investments. Transitioning a bit, some questions we get a lot are around PE terms, how they work, and what they mean. I would like to spend a few minutes on explaining how some of the PE terms work. The first is management fee. This is the fee you pay to the manager for running the fund, making investments, and then monitoring them. It is generally paid on a regular cadence and often declines over time. For example, it can be highest when the fund is in its investment period, when the manager is actively looking for opportunities and then managing them, and then declines post-investment period when investments have been made and the manager is now monitoring and evaluating exit plans. The management fee is often expressed as a percentage of some base. That base can be committed capital, invested capital, net asset value, or some other base. Let's walk through an example. Let's say you invest into a private equity fund and you commit $1 million. In year one, the fund has called $500,000 from you and invested that money. Its net asset value, or what it is worth today, is $600,000. The management fee is 2%. If your management fee is based on committed capital, then you will pay 2% on $1 million. If it is based on invested capital, then you will pay 2% on $500,000. And if it's based on net asset value, then it will be 2% of $600,000. Knowing the base of the management fee is important. A management fee on committed capital is more predictable than invested capital or net asset value. But it can also be higher, particularly in the early years when it takes time for a portfolio to ramp up. Knowing how your management fee is charged and how it will impact your returns is an important consideration when evaluating a PE investment. Management fees are paid regardless of performance, unlike carried interest, which is a private equity term for performance fee. Carried interest is a fee paid only if a fund achieves a certain level of performance, and the fee paid is a percentage of the fund's performance. Similar to management fee rate, there are different ways to calculate carried interest, and it is most important to understand prior to making an investment. For example, some funds charge performance fees based on each individual investment's performance, often referred to as American carry, while others charge it based on overall fund performance, often referred to as European carry. Others may have some sort of combination of those two. You may often hear the phrase 2 and 20. This refers to the most commonly charged fees by PE funds, which is 2% management fee and 20% carry. Fees will vary between strategies and managers. The hurdle rate, or high water mark, is the minimum return that a fund must generate to receive carried interest. For example, a hurdle rate of 8% means that the PE fund must return at least 8% to its investors before the manager can start earning carried interest. Oftentimes, PE funds also come with a clawback provision. This comes into play when performance fees paid earlier in the fund's life are retroactively returned if the performance later in the fund's life dips below the hurdle rate. For example, if a fund returns 10%, the investor pays the carried interest accordingly. But if at the end of the fund's life, the return drops to 9%, the manager will then have to return the carried interest it earned on the 1% difference. The clawback seeks to protect investors to make sure that the GP is aligned with the interests of their investors. These are just some of the terms at a very high level, but prior to making an investment, it is very important for an investor to know how these fees and various terms work. For example, when we conduct due diligence on a potential fund investment, we pay close attention to the terms and how they're structured. Now that we have gone over the high-level mechanics of private equity, next we would like to dive into the different kinds of private equity. Like public markets, private equity is a very general term, and within the asset classes are various strategies that each have their own unique characteristics. First, I'll give a high-level overview of the various strategies. Then we'll dive a bit deeper into some of the more specifics later on. The easiest way to think about the different strategies within private equity is to look at it from the perspective of the life cycle of a company. When a company first begins, it's just an idea that needs to be proven. Lots of investment goes into building the company and it hasn't yet made a profit. This is the beginning of a company, and investing in companies at this stage is called venture capital. Your money is going into building the business. These investments are generally higher risk, as you don't know if the business will be successful, but can also come with the highest reward given that you're investing very early into a business. Imagine if you invested into Apple on day one before it started making Macs or iPhones. But for every Apple, there are also numerous failed businesses. So venture capital may have the highest returns, but only a small number of highly proficient fund managers are able to achieve attractive returns. These businesses also tend to be on the smaller size, given how young they are. Once a company's business model has been proven and is off the ground, it may finally begin to make profit. This is when it enters what we call the growth equity phase. When making investments into growth equity, investors are giving capital to business owners who prefer to retain much of their business yet need capital to grow. As such, these businesses seek a strong private equity partner to provide that capital. These businesses are less risky than a venture capital firm, as they have begun to turn a profit and are looking to transition to the next phase of growth. The next strategy for private equity is buyout, which are businesses that are up and running but may need capital for a variety of reasons, such as strategic acquisition, investing in structural changes, or other operational and management changes. Buyout itself has various classes within it depending on the size of the company. Companies on the smaller end are bucketed into small and mid-cap buyout, whereas larger firms are in large cap. This is very similar to what you see on the public market side. Definitions of where small and mid-cap ends and where large cap begins vary depending on the investor and also within their industries. Finally, there are special situations. These tend to be companies that are later in their life cycle and may need additional capital infusions because they aren't doing great. For businesses that are struggling in distress, a private equity team can come in and make changes or help them with capital to fix their capital structure. This tends to be more of an opportunistic investment. Now let's do a deeper dive into each. Starting with venture capital and growth equity. Again, these are investments in early stage companies that require equity capital for growth. They have the highest return potential, think of your home runs, but also highest risk. Many of the venture capital companies today are either in technology or healthcare sectors. When investing in this strategy, you may get additional exposure in sectors that show attractive growth potential. When making a VC investment, investors are typically minority investors, but often have a board seat and therefore a say in the direction of the company. VC companies can go through multiple rounds of fundraising, where they look for capital infusion called series. There is an initial raise, often referred to as seed funding, followed by Series A, B, C, and so forth. At some point, the company may be sold or undergo an IPO. The key risks of these investments include execution of business plan, market acceptance, etc. The returns are more volatile than buyouts with greater range of outcomes. Successful deals can be home runs, as mentioned earlier, but unsuccessful deals can be a complete loss of invested capital. Growth capital is often grouped with VC, but it is later in the stage of the company's life cycle, where the idea has been proven, so slightly less risk, but also slightly less potential for the high returns generated within VC. Because companies in these stages are seeking equity more than anything else, they are less dependent on leverage to generate potential returns. They also tend to show lower correlation with other asset classes given how much of the risk tends to be company risk versus market risk. Buyouts are investments in the equity of established, mature companies using debt or leverage and equity to grow. They come in different sizes, which determines if they are small, mid, or large cap investments. Target companies typically exhibit sustainable, stable, and reasonably predictable cash flows. Investors' capital is used to finance expansions, consolidations, turnarounds, or other plans to increase the value of the underlying company. The focus here is to generate value derived from fundamental growth opportunities and operational improvements. Similar to venture capital and growth equity, the value of the investment is realized when the company is sold or undergoes an IPO. There may be use of leverage, which typically amplifies returns as well as risk. Leverage buyouts, commonly referred to as LBOs, represent the largest pool of capital in the private equity arena. This is where a lot of transactions happen because you're finding well-established companies, but companies that still have room to grow. This area is the core centerpiece for where activities happen in the private markets. These companies, because they're private, are shielded from public shareholders. They can operate in the private markets for a long period of time, whether they want to merge with another business or acquire another business. Just operating in the private markets has become a lot easier for business managers, as private equity allows them to make changes without worrying about stock price fluctuations and investor sentiment. Special situations encompasses a variety of strategies. These tend to be more opportunistic investments within private equity. There are 4 common types of special situations investments. The first is operational turnaround or deep value buyout. This strategy is focused on acquiring and fixing standalone companies and corporate carve-outs. The second is distressed debt, where the strategy is focused on restructuring over-leveraged companies or buying dislocated securities. Distressed asset strategies are where managers are acquiring and working out non-performing loans or acquiring hard assets such as aircrafts, ships, and plants. And finally, there's a catch-all category of very opportunistic investments that are capital solutions and complex niche investments. Special situations tend to be a very broad opportunity set, and if structured correctly, can have strong downside protection. Due to the unique nature of these investments, they can also enhance portfolio diversification. Some of these investments also tend to have shorter turnaround time and therefore can improve the capital efficiency of a portfolio and mitigate the J-curve. And with that, we have reached the end of our PE 101. We hope that this session has helped offer you more insight on the asset class. We encourage you to explore our other courses in our Private Markets Academy, where we at Neuberger Berman seek to educate our partners, elevate their portfolios, and empower you to achieve greater return potential. If you have any questions or would like more information on the session, please do not hesitate to contact your Neuberger Berman representative. Thank you, and we hope to see you again.